The Federal Reserve increased interest rates yet again, and you're probably asking yourself, what is the end goal and what are they trying to achieve? They're telling us they're going to calm inflation down, but if you look at some of the policies that they've put in place and the amount of money that they've printed all the while, it seems very unlikely that inflation is of their primary concern. So I'm going to break down some information today that you must be aware of. You came here for the truth, so let me unveil that for you. First things first, Fed increases interest rates a quarter point and signals potential end to hikes. So the Federal Reserve is known for what they call Fed speak. And Fed speak is a very convoluted way of talking so that it's never really 100% certain. There's always that question there. Alan Greenspan talked about this many years ago, saying that he specifically does this to cause uncertainty. And of course, during these periods of time, that's what we have a lot of. We have a lot of uncertainty. What's happening with this banking crisis that's going on today? You've had several failures, major failures that have taken place, and the markets are starting to ask the questions. And I'm going to show you some information. Look, I think it goes deeper than banking. I think it goes a lot deeper because the financial system itself is predicated on the idea that we're going to be here and accept whatever it is that they give us. The currency that we use today will not be the currency of tomorrow. Are you interested? Let's go on. You see, if you look at what has happened in a statement after the two-day meeting, the central bank removed previous guidance that some additional policy firming, aka rate hikes, may be appropriate. They go on to basically just suggest that, yeah, they're not as tight as they were before. They're loosening that up. Let me give you a little bit of insight. They did the exact same thing in 2006, almost word for word. And so the expectation from the markets here, and by the way, the algorithms that trade all this stuff, 90+% of trades done by algorithms, understand it's the same pattern as what they saw previously. And yes, the market did come down at the end of the day, but it is an absolute fact that we are understanding that the Federal Reserve is likely more to cut rates now than to increase rates. Now, why would they do that? Well, you're probably asking, this couldn't possibly be the case because the Federal Reserve said they want to get rid of inflation and they've increased this far. Why would they then cut rates? Well, the boom-bust cycle is created by these central banks in order to take advantage. Anytime there's a crisis, you have a group that can come in, scoop up assets, they can have an excuse to gain more control and power. And of course, they want to institute a central bank digital currency. And you can't do that without some sort of monetary crisis. So that's what we are undergoing here and now. I want to show you more about this. Stocks turn lower. The major averages turn lower following Jerome Powell's press conference. He said a few things, and I want to show you that, okay? The rate setting committee has a view that inflation is going to come down not so quickly. It will take some time, and in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. You see that? That's kind of the big thing. However, the markets, if you look at all the little financial instruments that surround the rates and everything, and they kind of make these predictions and so on, the futures, they are pricing in and they are starting to reflect rate cuts as soon as Jackson Hole, which is September of 2023. You subscribe to the channel, you will know all of that. Just hit subscribe, okay? You can see already this year, 4 months of this year, there are 70 major bankruptcies. Liquidation sales are on, including Bed Bath & Beyond. There will be more. That humming you hear is the credit cycle. Bloomberg large bankruptcies, that is $50 million in liabilities plus. And while we had back in 2009, 118, it's getting close. We're at 70 right now. And so we're not done here. We're not done with this tightening cycle. And there have been a lot of these companies that have been suffering. But don't worry, because you can see Elizabeth Warren is coming to your rescue. Well, she says that the US taxpayer will have to foot the bill if JP Morgan stumbles after First Republic buyout. Now, isn't that the whole point? Isn't that it? You have a big company like JP Morgan steps in, they buy up the assets. A lot of those assets are garbage. And so they're doing this in order to not have the government do it, right? Because the government could take it over, but that ultimately means you directly as the taxpayer. In this case here, if anything goes wrong, then it's the taxpayer's problem. That's right. But if everything goes right, JP Morgan wins. You see, JP Morgan is rapidly becoming the biggest bank in the entire world. They already were one of the most powerful in the entire world, along with Goldman Sachs and a few others. And now this is just one after the other. It's incredible, isn't it? Now, part of all of this is that you see, just for example, look at what JP Morgan does with the SNAP program. Food stamps aren't little pieces of paper you're carrying around. JP Morgan is the one that makes money off of the whole infrastructure surrounding food stamps today. And so you get your little card and they are the ones that benefit. Every person that's added to food stamps, every transaction and swipe, JP Morgan is winning. Every bank that's failing, whether it's directly, in this case here, they can come in and backstop the losses, buy up things, bail them out, or indirectly by they're getting scared out of some of these banks like SVB, and then they're putting their money with who they think is safe, that is JP Morgan. Do you see what's going on? Connecting all the dots. Would you like more? Let's go. US money market fund yields versus US bank deposits and some others in here. You could look towards the bottom there, that blue line. Well, we are off the bottom in terms of like the interest rates and, savings accounts giving you a little bit of a return. In the case of Apple, they're giving you 4.15%. That's really good actually compared to the rest. But look at the money market fund yields. That is the green line. And you could see that it's basically tied along with the Fed funds rate, and it's at approximately, let's just say, 5%. So you can have a good idea as to why investors have been pouring billions of dollars into money market funds. That's where the money's going. I've been covering money flows for years and years on this channel. And so when money leaves one area, let's say people were scared, they start selling their stocks, where does it end up? Well, I'm telling you right here, it's going to money market funds because people can get a guarantee, what they feel is a guarantee of 5% on their money, and they don't have to do anything. There's basically no risk for them. And while, we can argue about the rate of inflation currently, isn't it better to have a 5% return with essentially no downside? Or do you want to put it into a stock, which at this time, we're teetering on the edge a little bit? Will stocks go much, much higher right now? Or is it going to go up and down for the next while? That's what investors are doing, pouring billions into money market funds. Those are the winners right now, here, today. Sovereign debt costs to double by 2025 as rates rise. Governments seem stymied by markets, echoing UK. And just looking at this, this one particular company, Janus, positioning portfolios to invest in longer dated bonds. They don't want to have the same exposure that companies like SVB did, where they were overexposed on their balance sheets. Like they were basically taking in people's deposits, short-term stuff, investing in long-term stuff, and that created this mismatch when people tried to pull out their cash. Hopefully, this company is not doing the same thing. That's all I'm trying to say. Government interest costs are set to hit $2.8 trillion by 2025 as interest rates rise, constraining fiscal spending. That's the government. Fiscal spending is government, okay? And diverting money away from economically productive areas. That's what's happening here. So you could have it going into more investments, research and development, and all these things, but instead, people are worried. Right? It's going to, pay interest. That's not productive. Not at all. But somebody gets to benefit from that, let me tell you. Jerome Powell said that the failure to raise the US government debt limit would be unprecedented and have highly uncertain and negative effects on the economy. Do you think, like we've seen this so many times before, the Federal Reserve points the finger at the government points the finger at the Federal Reserve. This blame game is nonsense, okay? It doesn't even matter his quote, that's it. Risks of a brief default. So I wanted to show you this really quickly here because you could have the whole debt ceiling nonsense. There could be the possibility that because of this fake argument left and right and so on, that they cannot actually make their payments on time. What would happen? So right now at this time, you get the tax time. A lot of money comes in. People have to pay their taxes. So like you get just this bunch of cash. The government can exist basically for another month, maybe 2-3 months, whatever the case is, depending how much they get. So the chances of them actually defaulting right around this period is higher, let's say, than it was a couple months ago. And so they could default even for a short period of time. What happens? Like, what is the result of that? Let me show you. Should we breach the debt ceiling, the costs of the economy would be likely to be quickly felt. You could see even a brief default. A crisis characterized by spiking interest rates and plunging equity prices would be ignited. Short-term funding markets, which are essential to the flow of credit that helps finance the economy's day-to-day activities, likely would shut down as well. So you could see that U.S.'s credit rating would be moved to the restricted default. Affected treasuries would carry a D rating until the default was cured. So this creates massive problems even on a very short-term scale. I wanted to show you that. I don't think that's going to happen. I think they'll simply just, give it a temporary suspension on the debt limit, say, yeah, we're going to work on this, and then we get the bill at a later date. And as expected, dollar falls after Fed signals pause. Banking woes dent confidence. And so during this period of time, what we experience is very simple. And that is when the Federal Reserve or another central bank increases their interest rate, it strengthens the value of their currency. And of course, vice versa. So if they're willing to cut rates all the way down to the ground, well, then that weakens their currency. And this is the way that you find governments are constantly manipulating the value of their currency versus the others, and usually against the US dollar being primarily what they're trying to achieve. And they do that. They want to weaken their currency in some cases because they want to be attractive to exports. So China wants to keep their currency artificially down. Why? Because they're pumping all that stuff out to the United States. You stayed here for this part. I wanted to highlight something about China. Did you know this? That the Chinese manufacturers inside of China, they sell products to the US markets even at no profit at all. No profit at all. You might be asking, why? Why would they do that? Because they can take their receipts, send them to the government, and get a rebate back on that. Imagine that the engine of China operates, essentially the government subsidizing the manufacturing industry, and then that stuff gets shipped overseas. Do you see what's going on here? They are actively engaging in subsidy in this manner, and that's going to continue to boost them up, their economy. Yes, that's their problem with their debt and the deficit that they carry. But do you see the difference here? In the United States, you want to open a factory, you want to open a business, and they crush you. You want to do it in Canada, they crush you. They say there's rules, there's regulations, there's red tape. You got to file this, you got to file that paperwork. Oh, you can't do it. Oh, you need a professional to do that. Oh yeah, that's $1,000 a month. Oh, you can't afford it? Too bad, you're not starting a business. But you go to look at some countries like China, and they make these things happen. They do this in a way that's beneficial to the economy instead of trying to actively crush it. Why would you want to crush an economy? You might be asking, what's this guy talking about? You crush an economy when you want to bring in a central bank digital currency, when you want to bring in a new world, when you want to do this to have more control over the population, and of course make sure that there's a very few group of people, very few hands at the top controlling the many below. Does that make sense? I hope so. Amazon, by the way, speaking of companies and factories and so on, they're going to cut 27,000 roles, including many in HR. Well, if you're cutting people, you're going to need some HR people. Maybe they're going to do that with artificial intelligence or something. I really don't know. I want you to also make sure that you watch this video, okay? This is where we look at JP Morgan. We look at who's winning, cui bono, who stands to gain, who benefits from the scenario of a crisis. Guess what? JP Morgan, Jamie Dimon, these are part of it. If you haven't watched this video, click on this link and I'll see you there. Take care.